if you look at what we have, the time of day here and the next one's here. Okay, so what I'm watching is we had already traded up into this volume imbalance there. We went lower, and then we went one more time, bumped it. And remember I was telling you earlier that the bodies of the candles can go just a little bit outside of the PD array. The high of that PD array is this candle's close. So when we went above it here with this candle's close, the fact that it did that, it's so subtle that it's permissible. I allow that to happen and not change anything that I expect in price action. So when my algorithm is behaving like this, I am not looking at price and saying, oh, well, it's broken or they changed it. They didn't change anything. It's doing everything it's normally going to do. And the next candle confirms it because it stays where? Inside of that volume imbalance. So the market shows a willingness to go lower. So we had stops taken here. The market drops. And then right in here, what is this? If this run up takes out the liquidity and this gap with this volume imbalance, anyone else that doesn't know really what's going on, they may look at that and say, oh, this is a buy, and then look for it to go higher. So you can see that we have this inefficiency that's overlapped. I love the fact that when we drop down and we had this little wick, that little wick right there is a mohawk. This is what I refer to as a mohawk. Now, a mohawk is just where price has been allowed and you as the analyst afford it to behave in a certain manner that is just outside of what would be perfect. Perfect would be to stop it right at that candle's open because there's a volume imbalance. Whenever you have a volume imbalance that's part of a buy side imbalance or sell side inefficiency, you cannot just use the low of the wick. You got to use the volume imbalance. That's the true range of that inefficiency. Because you have two PD arrays agreeing with the same context of price being offered strongly with buy side, inefficient in sell side. It means it's got to offer this type of price action where it's dropping down over that same range between this candle's high and this candle's open, which is the volume imbalance. So we have now two deliveries, up and down. And then we have this. One more attempt to do something above it, and it wicks. See that? It wicks. That little tiny coloring outside the lines of that volume imbalance high, that right there and where we close with the bodies tells me that this should drop lower. The next candle we open drops lower. One more time to consequent encroachment. We break lower. We create an order block. This order block is part of this one. What kind of order block would this be? Propulsion block. So we have order block that reaches the high end of the inefficiency over here. There, it drops. This one here, this candle's body cannot breach half of the order block that it's traded back into. When you get that, it's kind of like a tipping of the hand. It says, we have an order block that should send price lower, and then there's another one that's digging into that previous order block. So you're really getting a lot of conviction placed around the idea that prices should be repelling away from this one and certainly away from this one. But we have this order block forming inside of a inefficiency. And the consequent encroachment of that inefficiency is right here. See that? So we wick up into, I was using this order block as my initial entry. You'll see it when I put the executions back on. I'll put my cursor so you can see where those entries were. And then as the live stream occurred, as we went into consequent encroachment of this wick, as soon as we hit half of that right there, I went in on that candle. I'll take that too. I'm not afraid that it might go higher. Why am I not afraid? Because I have an inefficiency here that has changed into an inversion. This is a little coloring outside lines. Could it hold on to that? No. And then we closed here, not at the high of the fair value gap, near the metal. And then the next one we do what? We confirm it. We open, trade outside of it. So what is it done here on that candle? What has it done? It's left this gap energetically, and look how it closed. So that means we can still trade up to consequent encroachment of this inefficiency because that's normal. That's normal. And it could be normal through the lens of the wick doing it only. what do we see here? We open, the body goes all the way up here, stops just by a little bit. So that little movement above that midpoint of this inefficiency is the same thing I've outlined here. That's a mohawk. So you would do the same thing here. But when it's a bold-faced bullish candle and it's all the way at the highest high, it's going to be terrifying to you in the beginning. You're going to second guess everything. And the market comes down here and closes outside the fair value gap, validating this right here. So this is just returning back to a level that's permissible. Then the market opens, indecisive candle. We want to see it drop away. It does. Now we know that this is a propulsion block. Why? Because its candlestick body did not close above or cross mid part of this candlestick, which is the order block. The propulsion block, its entire range needs to be referred to. And it went just a little bit above halfway point of that inefficiency. Now we're expecting this to be treated as an inversion fair value gap. So this is now inversion fair value gap. Whenever I have a range like this that's highlighting a fair value gap, if it's ever a hue, it's an orange, what I'm saying is its role has reversed. So whatever it would have been initially expected to deliver over here, dropping down, it should go higher. That's what the myopic view is. But then when it gives up the ghost and leaves it here, and then we get it confirmed there, everything going future, allow for it to trade back up into here, but stay out of what? What should it stay out of? What should price not do? Explore in the upper part. That means this. This shaded area here should not be traded to in this inefficiency. We worked the lower half of it. We mohawked above it. But this portion, so this is the portion, if it's really valid, if it's very, very strong, if it's going to send price lower, we will be encouraged and we'll know we're on side. That means we're on the right side of the marketplace. If any rallies that can be done with a wick, because the wicks can do what? The damage. That running up into that, we should not be fearful of that. We should be comfortable with it. And my stop loss was above the rejection block, which is the up close in this swing here. We have high, higher high, lower high. The up close, the highest up close in there. So I've used the rejection block because it's already worked it here. We traded above that closing price on the next candle. Then it rejected it. We went right up to it here and delivered the same price. It looks like the same price, doesn't it? What's the high of that? 592 3/4, and the close is 592 3/4. So it just tagged it right there. How is that not proving the logic of a rejection block? It needs to be traded to one time, and then if it's good, it should not go back there again. And here it is. It stops dead in its tracks. It never goes above it. See that? And then this little run here, it's me using this wick. So I measure, and this is, now I'm sharing this logic with you, so that way every example I show in the future, you're going to see that if I'm using trade formations like this, it's the same logic repeating. But that is consequent encroachment. And as it slammed up into that, I said, oh, I'll take that too. Trusting that my stop loss is not going to get hit because of the logic I just outlined all here. So as it went up there, as it jammed up there like that, as soon as it jammed up in there and hit that wick, because I was looking for it, I said, watch this right here. And then poof, it slams up into it. As soon as it touches the consequent encroachment at that level, I'm hammering it right at the market, selling more. Now, I'm expecting, because it did this, it should not trade back into this portion of this inefficiency. Okay, so in other words, I don't want to see the upper half traded to. I want it to stay keeping that portion open. Because we had so many qualifiers in here saying that the rejection block has done its job. That's algorithmic. That high, 19,592.75, just happens to be the same price of that closing price, 19,592.75. So everybody's buying and selling pressure just happened to agree. When we're looking at how the market drops away from this right here, this rejection block, this consequent encroachment is not going to go back to the rejection block. So I'm not freaking out that my stop's going to get hit. So I'm using the same logic. And you're all questioning, dude, please teach stop placement. Please teach how you're putting the stop losses where, how I need to get that skill. You're learning it right here. Every single time I lecture and I teach, I'm teaching that. But it's one component that needs to be relying on other things that are supportive. So that's why I'm trying to tell you, anybody that's lying to you and putting on a facade that they're going to somehow shortchange and make it easier for you to learn this, It's impossible to be shortened. There's so many things that have to lean on one another for it to mesh perfectly. Just because that's, a inversion fair value gap potentially there doesn't mean that I'm going to trade it unless I have other things supporting it, like an order block. An order block has to have other things around it. It's not just an up close candle, and it's certainly not just the last up close candle before the down move. You're learning at PhD level. So the market gives me a perfect execution for another pyramided entry. So as it slams into that level right there, I'm confident that it's not going to rejection block, which is this up close candle's closing price. Because everything I've outlined here has fortified and solidified my confidence is valid, and I don't need to worry about it. It's not going to my stop. So if it gives me another premium level, which is this one here, because it should not touch the low of that upper half of that inefficiency. Why? Because when it's bearish, the upper half, the premium aspect of that individual PV array, the upper half, once it leaves it, or it assumes that it should not come back there, in my mind, I want to see that area fail to ever be redelivered to. Here's the first one. I'm hammering the opening price right here on the propulsion block. The propulsion block, I'm hammering it as it hits it there. And then the next candle gives me even better placement, which is the consequent encroachment of that wick. And right there it is. See it? Look right there. Beautiful placement there. Hits it, falls short of the bottom of that inefficiencies, upper half. And then I want to see price start to get heavy, start to get real heavy. And the low on Monday, the liquidity below the previous day's lows, the highest high and the lowest low in the last 3 trading days, you have to have that information all the time. The last 3 days, whatever the highest high was and the lowest low, you have to have that information because the market will refer back to that. The previous day's high and the previous day prior to that. So what you're looking for is the highest high and the lowest low in the last 3 days. Then you're looking at the high and the low of the day 3 days ago. It's not the same thing. Listen to what I just said, the highest high and lowest low, because you're going to also refer to, like for instance, say today's Tuesday, we're going to look at Monday's highest high, lowest low of the day, or its daily range, high and low. Then you're going to look at Friday's high and low, and then Thursday's high and low, not Sundays. Sundays are treated differently. The only information I pull from Sunday is the opening on the new week opening gap. I don't crossing over to midnight and New York local time. I don't care about that. I'm looking just for the opening gaps that form on Sunday's 6 p.m. opening. That's Forex and that is futures. It's everything. Okay. Apart from that, Sundays are a nothing burger to me. But that is really important information looking at where we open at on the new week, because you can take that information that's been proven here, you extend that out in time, and it's useful for weeks and months. And it's alien to people prior to not learning it from me. They have no idea that it's even there. But look how many times there's setups. Look how many setups that form, how many times it gives you a draw on liquidity. Main thing is daily highs and lows, the liquidity above and below those reference points. You want to have that in your list of things to observe. They will act as draws on liquidity. The market will gravitate to those, just like a new week opening gap, just like a new day opening gap. So it helps you understand liquidity. It helps you have a steady supply, never running out of setups. You're never going to run out of yeast as a baker, okay? You're never, ever going to be shortchanged on opportunity because there's always going to be a previous day's high and a previous day's low. So I'm going to teach you the basic elements of what I was teaching when I was on baby pips back in 2010. The liquidity below the previous day's low, and when we start getting in close proximity to it, okay? So what that means is we're watching price dropping down, and everything in price action was supporting the idea that it's going to keep going. How do I know that? How can you know that? How can you trust that it isn't going to reverse? Like you're trading inside this area here, like while you're looking at the price lights. Like when you see that, what are you trusting? What are you leaning on? What's the logic that tells you this is going to keep dropping, ICT? Well, number one, it's trying to get down to the previous day's low where there's real orders resting below that. What kind of orders? Sell stops. Okay. So if I know that we're pretty uniform in the way we keep dropping, my eye goes to what I teach you. This candlestick right here is an order block. If I find that, and then every successive subsequent candle after that to the right as it's forming. As we move away from it, if it comes back up into this candlestick, is it able to overtake half of this candlestick? In other words, think about it like this. I'm teaching you order flow. This is real order flow. So here is half of that order block. Okay. Did this candlestick or this candlestick come up and touch that halfway point, or which would be mean threshold? No. That's exactly what I want to see on our order block. Okay. The market trades lower. This candlestick trades up into this candlestick. So what does that make this? Propulsion block. So price should do what? It should trade away from that. Now, in this little area right here, we have a volume imbalance. That's what this order block delivers to. This candlestick, and this candlestick is working inside of this inefficiency where we had the body here. This candle's indecisive. It's just basically the open and close is the same price, and we have a high and a low. That's indecisive. Usually when you see an indecisive candle like that, you're building a volume imbalance. And the next candle, you'll see it's there. Boom. Find that in Steve Nielsen's book. But the rally back up just fills in that little void there. It's no bodies. It's absent of having any bodies. So the market will do patchwork. That's the technical term for it, by the way. I wasn't supposed to say that, but fuck it, it's a live stream. The algorithm is doing patchwork where it fills in these inefficiencies. Okay, so when it does that, then the market displaces and goes lower. At this moment, we can now see it goes back up, trades one more time. What is it digging into? The original order block. That is a reclaimed bearish order block. Why? Because we've already moved away from it and it's coming right back up into it here. It needs to show immediate response, drop lower. Does it? Yes, it does. And then we retrace back into this little area here, fair value gap, trades back up into it, hits it. Does that send price lower? Yes. Price displaces lower, takes out this low, trades up into this area here, matches the high here. Does it have any willingness to get up in this inefficiency? No. And then breaks lower right there. What I have right there is a market indicating in every shape, facet, or form that it's heavy. It means it's really, really heavy and it's going to be easy for it to fall. The heaviness in price is proven right here. So I'm confident that when we traded up into this area here, I'm not going to see the upper half of this close in. Upper half of this, watch. See that? Now, what have I been teaching in 2024 mentorship? PD arrays, the highest form, the highest order of order flow around them is when you're bearish, the upper half are not traded to. When they're bullish, the lower half are not traded to. But the upper half here never trades to it there. So I'm getting short on this candlestick as it's already proven here, here, and here, and I need to be in. I need to be in on the move. So that's here. I do trust that we're not going in the upper half of this range here. So this is what I'm visually seeing. It's not going to go up into this portion here. That's my belief. Why? Because everything all through here is indicating that it's heavy. We're real heavy. We couldn't even do institutional order flow entry drill here, and we had this big drop down. Now, when you're watching this might feel like, oh, well, it's been dropping. It's got to turn around. It's got to turn around. It keeps dropping. That's not what I'm thinking. Why? Why am I not thinking that? Because this is the previous day's low. It's indicating every way it can that is in a hurry to go down below the previous day's low. The previous day's low is like a honeypot. It literally is like a honeypot. It's always there every single day, previous day's high and previous day's low. If we open in the lower half of the previous day's range, you should always look for some kind of return back to the previous day's low. That's simple market 101. Like it's a normal thing for that to happen. I am not wanting it to trade up here. Once it does all these things in here, I want to be in on the trade because I know it's getting ready to take off. The very next candle, what does it do? It opens and off to the races we go. And then we create what? Another opportunity for it to create a volume imbalance in here. So I'm expecting price it opens, it trades back up into this candlestick's range. When this candle opens up here, I'm watching to see it dig back up into this candle. I am trusting that it's not going to go back into the upper half. So I just want to get in any portion of this lower part of this candlestick. Watch my fill. See it? Here's the low of that candle right there. It opens and it's digging into this portion of the range. I want to add to it. There you go. Selling more. And then I get another opportunity here. What's it digging into? The volume imbalance. I want to be filled there. As the candle's going up, I'm filled it right there. Bang. And then what does the market do? Rolls over, energetically runs right below some random level, the previous day's low. And there it is. But tell me how that logic right there, I couldn't have made that any better. To get that exit price, I have to have the fill that the low of the candle forms. So anticipating this large range is down, incoming in the recording, is because we were approaching Monday's low, and it's going to dig aggressively and fast to get down there and get those orders. Because as it's going closer to that previous day's low, anyone that has their stop down there has the ability to do what? Quickly say, I'm getting out and I'm going to protect myself and remove the order. So the first run into them is always going to be fast and sudden. Boom, sudden, real quick, because they don't want to let them pull the order. And that's the signature that when I am saying I'm expecting speed, I want to see distance and speed, or I want to see the magnitude of the move to increase right here. I'm indicating that I'm expecting the pool of liquidity that's next in order of business going lower or higher. They're going to quickly run for that because they are not going to let them pull those orders. So as the algorithm delivers lower, 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 when it gets in a proximity of this low, it will naturally speed up. What does that mean? It does not matter how many people are coming in to buy it. And it doesn't matter how many people are selling short. That's why when you're watching price, it's here, then it's here, and you think it took a long time for that 1 minute candle to do all that. It's gapping down. It's very speedily dropping, and it keeps offering lower prices. And it gaps lower and lower and lower and lower. And inside these individual candles, look at them, study them. If you have access to do like a 1 second chart, 5 second chart, you'll see it's porous price action. It's not a smooth one single candlestick of movement going lower. It's jumping and skipping down there because it needs to get quickly down below that previous day's low. That's a mechanism that's coded inside of the algorithm, which cancels pulling here. It's jumping and skipping real, real fast to get down to those orders. It doesn't need but one contract to book that price. One contract. That's all it's doing. It's going down here no matter how many people are buying and selling it. And the sooner you realize that, the easier this becomes. Think. If it's logic, that's sound, and it repeats, then you should be able to go in the charts and see it repeating. What is it doing over here? We have a low, a lower low, and digs in one more time. Right in here. So it's absorbed all of the liquidity below Monday's low.